If you buy a stock for 100 pesos and a week later the market tanks and you sell it for 90 pesos, taking a 10 peso loss, you shouldn't owe the government any taxes on that sale, right?
I mean, logically, you'd think so.
Right, but you'd be wrong. Welcome to the counterintuitive, highly specific, and notoriously tricky world of percentage taxes.
It really is a minefield out there.
Yeah, so if you are tuning into this ICPA Review Radio Deep Dive, you already know the stakes. You're prepping for the taxation board exam, and our mission today is to help you survive the deliberate traps hiding inside sections 116 through 128 of the Philippine tax code.
And honestly, those traps are everywhere. The examiners, they don't just want to know if you can memorize a rate.
Right.
They want to see if you actually understand the underlying mechanics of how these taxes operate.
Yeah.
Because the moment you rely entirely on, rote memorization without understanding the why, you will definitely pick the wrong distractor in a multiple choice question.
Ugh, I feel that exam anxiety already. So, to kind of anchor ourselves, I've always pictured the Philippine business tax system like this massive toll road network.
Okay, I like that visual.
Yeah, so if a business is huge, say they're grossing over 3 million pesos, they're basically driving a massive 18-wheeler. They have to drive on the V8 highway.
The main highway, yeah.
Right, and it's a really complex road because they have to keep track of every single toll booth ticket they collect along the way. That's their input VAT, which they use to offset the tolls they charge their customers, the output VAT.
That is a highly accurate way to visualize it.
Yeah.
The VAT system is entirely about tracking that chain of expenses and offsets.
Right, but what if they are driving a smaller vehicle? Or what if they're driving something highly specific, like a domestic passenger bus or a water utility truck or, and we'll get to this, a racehorse.
Racehorse, yeah. They take the percentage tax side road.
Exactly. And the beauty or maybe the curse of this side road is that the government doesn't care about your gas money or your toll tickets.
No, not at all.
They don't care about your expenses or your input VAT. They just look at how full your truck is at the end of the quarter, your gross receipts, and they charge a flat fee.
Precisely. It is a tax on gross sales or gross receipts. No deductions for the cost of goods sold, no operating expenses.
It's just a flat cut.
Right. And that is the very first conceptual hurdle you have to clear. Let's look at the baseline general rule under Section 116. If a non-V8 registered person has sales that fall below the VA threshold, they're generally subject to a baseline 3% percentage tax.
3%, I mean, that sounds easy enough, but I've been looking at recent mock board exams, and there is a massive red flag waving over this section regarding dates.
Oh, absolutely. The dates are everything right now. Under the CREATE Law, Republic Act 11534, the government temporarily dropped that baseline rate from 3% to 1%.
Oh, wait, but that was just temporary rate.
Yes. That window was strictly from July 1st, 2020 to June 30, 2023.
So if I'm sitting in the exam room sweating over a computational problem, and I see a transaction dated, say, December 2022.
You apply the 1% rate.
Okay.
If you instinctively use the 3% rate, your incorrect answer will absolutely be waiting for you in option A or B. Examiners do that on purpose.
Of course they do. They love that.
Yeah, so you must scan every single problem for the transaction date.
Mm.
And while you are scanning, keep an eye out for the word cooperative.
Oh, right, because cooperatives are explicitly exempt from this 3% gross receipts tax, according to the source material. I can totally see that being a sneaky true or false item.
It frequently is.
Okay, but let's move from the general rule into the specific industries. Let's talk about things that physically move. Sections 117 and 118 cover carriers, transporting people and goods. And I'm just going to voice what every reviewee feels here. The rules seem completely backwards.
They often do, yeah, until you look at the economic logic behind them. Let's separate domestic from international first. Section 117 states that domestic carriers by land for the transport of passengers pay a 3% percentage tax on their gross receipts.
And there are a couple of exemptions to that, right?
Just a couple of tiny ones, yeah. Owners of bancas and animal-drawn two-wheeled vehicles. But generally, if you move people by land domestically, you pay the 3%.
Okay, here's where my brain starts to hurt. If I run a domestic bus company, and instead of filling my buses with people going to Baguio, I rip the seats out and fill those same buses with crates of commercial vegetables, freight, and cargo, I don't pay this 3% percentage tax anymore.
You do not.
Why on earth wouldn't the government want a piece of that cargo revenue under this section?
Oh, believe me, they get a piece of it, just not on the percentage tax side road.
Oh, okay.
You have to think about the nature of cargo versus passengers. Cargo, like those crates of vegetables, is part of a supply chain. It's a good being transported for commerce. The government wants cargo tightly integrated into the VAT highway because it allows businesses to track and pass along that input VAT.
Ah, so it stays in the tracking system.
Exactly. Domestic passenger transport, on the other hand, is usually the end of the line. The passenger isn't reselling their bus ride, it's final consumption.
That makes sense.
So the government simplifies it. 3% flat percentage tax for domestic passengers. But domestic cargo gets kicked over to the VAT system or local taxes.
Wow. Okay, so domestic equals passengers because it's final consumption. But then Section 118 flips the script for international carriers. If an international airline or shipping carrier is doing business in the Philippines, they pay 3% on cargo, not on passengers.
Yes, 3% on the gross receipts derived from the transport of cargo departing from the Philippines to another country.
Why the flip, though? If I'm an international airline, flying people is like my entire brand. Why am I not paying percentage tax on passengers flying out of Manila?
Because of the principle of territoriality and, well, international agreements. Passenger fares on international flights are often subject to different tax treatments. Sometimes they're exempt just to avoid double taxation between countries.
Right, that would be a nightmare.
It would. However, for outbound cargo, the Philippines exerts its taxing authority on the revenue generated from goods originating from its territory. So for the exam, your lifeline is just this: domestic transport focuses on passengers. International transport focuses on cargo.
Domestic equals passengers. International equals cargo. Mix those up, and you lose the points.
Exactly.
Got it. So we've covered moving physical things. Let's transition to moving invisible things like utilities and information. Section 119 covers franchises. Gas and water utilities pay 2%. But it gets a bit more complicated with radio and television broadcasting companies, right?
It really does. Radio and TV broadcasters pay a 3% franchise tax, but only if their gross receipts for the preceding year do not exceed 10 million pesos.
Okay, so that 10 million is the ceiling to stay on the percentage tax side road. But the source material notes they can actually choose to leave the side road. Like, even if they make under 10 million, a radio station can voluntarily register for V8. Why would a company volunteer to pay a 12% V8 instead of a 3% percentage tax? That sounds like terrible financial management.
It sounds terrible until you remember the toll road metaphor. What if that small radio station just spent 50 million pesos upgrading all their broadcasting towers and studio equipment?
Okay. They paid a massive amount of V8 on all that equipment.
Exactly. That is a literal mountain of input V8. If they stay on the percentage tax side road, they can't claim any of it. But if they opt into the VAT system, they can use that input V8 to offset their tax liabilities.
Okay, that makes total business sense then.
It does, however. The examiners love testing the trap attached to this choice. Once a radio or TV company exercises the option to register for VAT, the law states it is strictly irrevocable.
Wait, forever? What if the next year they don't buy any new equipment and their revenues drop? Can they just say, never mind, we want the 3% flat rate back?
Absolutely not. It is a one-way ticket. Once you opt into VAT as a broadcaster, you are a VA taxpayer permanently. And that is exactly how the question will be framed on the board exam.
That is brutal, but really good to know. Okay, keeping with the theme of moving information, Section 120 hits us with a heavy 10% tax on overseas dispatch, message, or conversation. The classic example, if I pick up my phone in Manila and call my grandma in the United States, I pay that 10% tax on top of the service fee. But if she calls me from the States, there's no percentage tax here.
Right, because it relies on the origin of the dispatch. The tax is paid by the person paying for the services rendered in the Philippines. But your job as a CPA candidate isn't just knowing the rule, it's memorizing the exemptions. Because not every overseas call gets hit with this 10%.
Let me guess, the government probably exempts itself.
You'd be correct. The government of the Republic of the Philippines is exempt. So are diplomatic services like embassies and international organizations with specific agreements.
Are there any others?
Yes. There's a fourth exemption that frequently appears on exams, and that's news services. Messages from news agencies dealing exclusively with the collection or dissemination of news through public press or broadcasting are exempt.
That makes perfect sense from a public interest standpoint. We really don't want to penalize the free flow of international news.
Exactly.
All right, so we've moved goods, we've moved information. Now let's talk about moving money. Sections 121 and 122 govern banks and non-bank financial intermediaries. This is the gross receipts tax, or GRT, and man, it's a minefield of computational traps.
It really is. And it all comes down to the maturity period of the lending activities or financial leasing instruments. If a bank issues a loan, you have to look at the lifespan of that instrument.
Okay.
If the maturity period is 5 years or less, the gross receipts tax rate is 5%. But if the maturity is more than 5 years, the rate drops significantly to 1%.
Okay, so 5 years or less is 5%. Over 5 years is 1%. The government is clearly incentivizing long-term lending by giving banks a lower tax rate. That seems pretty straightforward.
It is, until the word pre-termination shows up in the problem.
Oh no. What does pre-termination do to the math?
Let's walk through it. Imagine a bank issues a 6-year loan to a corporate client. Because 6 years is greater than 5, the bank legally calculates and pays a 1% tax on the interest receipts.
Right.
But near 3, the client comes into a windfall of cash and decides to pay off the entire loan early. They pre-terminate it.
Okay, so the loan technically only lived for 3 years, but the bank already paid taxes assuming it was a 6-year loan.
Exactly. And the law states that in the event of pre-termination, the maturity period is reckoned to end as of the date of pre-termination. That loan is now legally classified as a 3-year loan.
Wow.
And because 3 years is less than 5 years.
The tax rate was supposed to be 5% all along. Wait, does the bank have to go back and pay the difference?
Yes, they do. They must retroactively apply the 5% rate to the gross receipts and pay the deficiency.
That's rough.
It is. So when you are taking the exam and you see a bank computation problem, you need to physically circle the original maturity date and then actively scan the rest of the paragraph for the word pre-termination. If you miss that word, you'll calculate the entire problem using the 1% rate, and you absolutely fail that question.
That is devious. Circle the date, hunt for pre-termination.
Got it.
Okay, from the serious business of banking, let's shift to my personal favorite section of the tax code. Sections 125, 125A, and 126, the fun and vice taxes.
Examiners adore the amusement taxes in Section 125 because there is very little theory involved. It is just a pure test of your memory retention.
I actually have a visual trick for this one. I call it the escalator of vice. Imagine you're stepping onto an escalator, and as the activity gets a bit more intense or gambling-focused, you ride higher and the tax rate goes up.
I like this. Let's hear it.
So on the bottom step, you have boxing exhibitions at 10%. Take a step up to professional basketball games, you're at 15%. Step up again for cockpits, cabarets, and night or day clubs, you hit 18%. And finally, at the very top of the escalator, gambling heavily, you have Jai-Alai and racetracks at a massive 30%.
The escalator of vice.
Yeah.
10, 15, 18, 30. And it's a great recall aid.
Thanks.
But be careful with the tax base. The law specifies that for amusement taxes, gross receipts must include income from television, radio, and motion picture rights.
Oh, really?
Yes. So if a multiple choice question lists ticket sales at 1 million pesos and broadcast rights at 2 million, you must tax the full 3 million.
That's a good catch. But let's rewind to the bottom of the escalator. Boxing is 10%. But you know, every Filipino knows that sometimes major boxing matches are magically tax exempt. Is it just whenever a local hero fights?
Not quite. It's not that simple. It is a strict all-or-nothing 3-part checklist. To be exempt from the 10% amusement tax, first, a world or oriental championship in any division must be at stake.
Okay, championship fight.
Second, at least one of the contenders must be a citizen of the Philippines. And third, the promoter must be a Philippine citizen, or a corporation where at least 60% of the capital is owned by Philippine citizens.
Wait, so if a Filipino contender fights for a world championship in Manila, but the event is promoted by a 100% foreign-owned American promotion company?
The exemption fails, the 10% tax applies. All 3 criteria must be met perfectly.
Oh man, that is a classic exam trap right there.
Yeah.
They will give you a scenario that meets 2 out of the 3 criteria just to test your nerve. Now, speaking of vice, the source material explicitly calls out Section 125A, which covers offshore gaming licensees, or POJOs. This is relatively new to the code.
Yes, it is, and highly testable. POJOs are subject to a 5% gaming tax. But what is really unique here is the definition of the tax base.
How so?
The 5% is levied on gross gaming revenue. And the law defines that specifically as Gross wagers, less payouts.
Let me make sure I'm hearing this right. Gross wagers, less payouts. So if 1 billion pesos in bets come in, but the house pays out 800 million to the winners, the tax is only on the 200 million difference.
Correct. It essentially taxes the house winnings.
Gra-
And this 5% is in lieu of all other direct and indirect internal revenue taxes and local taxes on that gaming income. They just have to remit this to the BIR not later than the 20th day of the following month.
Okay, so the house pays tax on what it keeps. But what about the guy who actually wins? Like, what if I go to the racetrack, the one sitting at the very top of our escalator paying the 30% amusement tax, and I win big on a horse race?
Well, then you will meet Section 126, the tax on winnings. The standard rate is 10% of your winnings or dividends based on the actual amount paid to you minus the cost of your winning ticket.
Okay, 10%.
But there is an exception. If your winnings come from double, forecast, quinella, or trifecta bets, the tax actually drops from 10% to 4%.
Okay, I have to challenge this. Why on earth would the government tax a standard bet at 10%, but lower the tax to 4% for someone placing a really complicated trifecta bet? Shouldn't gambling be taxed equally?
You have to view it through the lens of behavioral economics. Those complex bets, guessing multiple horses in an exact order, they have astronomically longer odds. They are significantly harder to win.
Sure, they're way riskier.
Right. So if the government kept the tax at 10%, bettors might just stick to simple, safer bets. By lowering the tax rate to 4% on the complex bets, the system effectively subsidizes the risk. It incentivizes bettors to chase those longer odds and place more complex wagers, which ultimately drives more revenue through the track overall.
So the tax code is literally acting as a casino manager, encouraging riskier behavior to boost total betting volume. That is fascinating and, well, weirdly logical. All right, we're in the home stretch. Let's tackle sections 127 and 128, stocks and compliance deadlines. Section 127 covers the tax on the sale of shares of stock.
Right, and there are two distinct categories here.
Yeah.
The first is shares of stock listed and traded through the local stock exchange. The tax is 0.6%, so 0.6% of the gross selling price.
And this brings us all the way back to our very first thought experiment. 0.6% of the gross selling price, not the net gain.
Exactly. It does not matter if you made 1,000,000 pesos in profit or lost everything. The percentage tax is a transactional tax paid by the seller based purely on the gross selling price.
Okay, so that covers listed stocks. What about unlisted ones?
The second category involves initial public offerings, or IPOs, specifically for closely held corporations.
And just to remind everyone, a closely held corporation is one where at least 50% of the outstanding capital stock is owned by 20 or fewer individuals.
Okay. That's correct.
Yeah.
So when they go public and sell shares, they face a tiered percentage tax rate. It'll be 4%, 2%, or 1%.
4, 2, and 1. But in the heat of the exam, how do I know which rate to apply without getting them completely backwards?
You just have to look at the proportion of shares being sold to the public. There is an inverse relationship here, and it's designed as an incentive.
How does that work?
The government wants these tight-knit corporations to open up ownership to the public. So, if you are stingy and only sell a small portion, up to 25% of your total shares, you get hit with the highest tax rate of 4%.
Oh, I see it. It's like a volume discount.
Exactly. If you sell over 25%, up to 33.33%, the rate drops to 2%. And if you really open the doors and sell over 33.33% of your company to the public, you are rewarded with the lowest tax rate of 1%.
So the more control you give up to the public, the lower your IPO percentage tax.
Got it.
That makes total sense when you understand the motive. So up to 25% gets taxed at 4%. Between 25% and 33.3% gets 2%. Over 33.3% gets 1%. Memorize that volume discount logic and you really won't miss the question. Finally, Section 128, returns and payment. We know all these rates now, but when is the paperwork actually due?
Well, the standard general rule is that taxpayers liable for percentage taxes must file a quarterly return and pay the tax due within 25 days after the end of each taxable quarter.
25 days, but I'm waiting for the exception.
The exception is the retirement trap. If a person's retiring from a business subject to percentage tax, the timeline shrinks. They must notify the BIR, file their return, and pay the tax due within 20 days after closing their business.
So a normal operating business gets 25 days. A closing or retiring business only gets 20 days. It's just a 5-day difference, but on a multiple choice exam, that 5 days is the difference between passing and failing the item.
It absolutely is. And one last warning on compliance under Section 128. If a taxpayer fails to issue receipts or just doesn't file a return, the Commissioner of Internal Revenue has the authority to assess a minimum amount of gross receipts based on similar businesses in the area.
Oh, wow.
And this assessment is considered prima facie correct.
Meaning, if you don't do your own math, the BIR will do it for you by looking at your competitor next door, and you will have an incredibly hard time proving them wrong. You do not want that.
Never.
Well, we have navigated the side roads, explored the behavioral economics of horse racing, and made it through the percentage tax minefield. Before you hit pause and dive back into your review materials, can you give us a rapid-fire 4-point recap? The absolute must-remember exam day checklist for sections 116 to 128.
Gladly. Here's your exam day checklist. Number 1, carriers. Remember the rule of physical movement. Domestic passenger carriers pay the 3%. International cargo carriers pay the 3%.
Got.
Number 2, bank loans. Circle the maturity date. 5 years or less is 5%. Over 5 years is 1%. And heavily scan the problem for the word pre-termination, which forces a retroactive tax adjustment.
Right, check the cargo, hunt for pre-termination. What's number 3?
Number 3, amusement taxes. Visualize the escalator of Vice 10, 15, 18, 30, and memorize the strict 3-part rule for boxing exemptions: championship at stake, Philippine citizen contender, and a Philippine majority promoter.
Perfect.
And finally, number 4, stocks. The 0.6% tax on listed stocks is based solely on the gross selling price, never on your net gain or loss.
Lock those 4 points into your brain, and you are going to secure some crucial points on exam day. As we wrap up this ICPA Review Radio deep dive, I want to leave you with one final thought. We spent this whole time analyzing percentage taxes from the perspective of the business, the bus company, the water utility, the airline. We focused on their gross receipts and their tax liabilities. But think about the mechanics of how a gross receipts tax operates. It's really just a flat fee built into the revenue. The next time you pay your monthly water bill, or buy a domestic airline ticket, or pay for an overseas phone call, take a look at the final price. Ask yourself, is the ultimate economic burden of this percentage tax really being absorbed by that massive corporation, or because it's seamlessly baked into their gross revenues, is it secretly being passed down the toll road directly to you, the consumer?
That is the invisible reality of indirect taxation.
Keep grinding, trust your preparation, and go crush that CPA board exam. You've got this.